Welcome to another one of our Money Talks videocasts. This is Thanksgiving week, Monday of Thanksgiving week 2010. Basically, the markets have changed their tenor a little bit since the last video that we have done here. And that is that the Fed has decided that they're going to do QE2. And what's QE2, quantitative easing 2, it's just another code word for bailout. And they're bailing out the banks, so to speak. They must think that the banks have a lot of problems on their books, because basically what they're doing is they're printing another $600 billion in new money, and they're buying treasuries from the bank. And then these are 16 or 18 basically money center banks, or what they call primary broker dealers. And the broker dealers are the ones who buy treasuries from the Fed, and then they're selling it, buy treasuries from the Treasury, and then they're selling it to the Fed. I mean, if the Fed really wanted to bail out just the straight economy, they'd be buying the treasuries from the Treasury as opposed to buying these from the banks. So the banks buy it, and then they get to mark it up, and then they sell it to the Fed. I mean, if that doesn't confuse you, it is confusing in the fact that what they're hoping is that these 18 broker dealers will then take the money and either lend it out in the form of loans, which really isn't happening too much more than it has any time in the last couple of years, or they're keeping it on their books, which doesn't earn them much money, or they're buying more treasuries, which the spread is very narrow, or they're buying stocks. And when this was announced on November 3rd, Fed Chair Ben Bernanke made comments or wrote a editorial op-ed piece saying, we're trying to drive the stock market higher and 401ks higher. So that caused us here at Pacific Financial Planners to kind of take a different tact. Before, we were always operating with a lot of cash and maybe 0 to 50% invested for the last period of time, most of this year, 2010. Now we're 50% invested in deciding whether or not to go even longer with the other, to more. But at the same time, we're not going to put our guard down, because what's happening over in Europe is very concerning. It's the same problem. I mean, back when Greece was having its problems earlier this year, everyone talked about the pig countries, which was Portugal, Ireland, Italy, Greece, and Spain. Well, Greece got the bailout. Well, Ireland now just is taking the bailout money now. Everyone realizes that Portugal and Spain are in some trouble. Italy's got problems. And is it a domino effect? Are they just going to continue to fall down the line? Everyone feels better when they say, oh gosh, they took the bailout money. Oh gosh, they're bailed out. Oh, everything's better. But where's that money come from? Just like this new QE2, where's that money coming from? We're printing more money. We're devaluing the U.S. dollar. Now, with the problems going on in the Eurozone, and they got to bail out their countries, that's devaluing the euro. So, and obviously Japan has their own problems. So as these two continents continue to devalue, it's a race to make their money lower. Everything depends on the dollar. UUP is the exchange traded fund that's a proxy for the US dollar. As that goes up, the markets will go down, and as that goes down, the markets will go up. The US dollar is the world's reserve currency, so the proxy is watching the dollar, because everything's priced in US dollars. So as the dollar gets weaker and goes cheaper, oil, US stocks, gold, silver are all valued in dollars, so they're going to go up in value, in particular commodities, because China's buying a lot of commodities. Now we see China's having their own problems. They're seeing that they're having inflation. They're afraid that the bubble might burst. So they're tightening credit. They're tightening reserve requirements at their banks. They're raising those requirements. So all those things might slow down the global leading economy, which is China. A lot of people are talking about China in a real estate bubble, China in an economic bubble. If that bubble were to burst, the whole globe would be in some deep trouble. So we're not out of the woods by any stretch of the imagination. We're playing a little bit longer right now than we have in the past. We're owning some U.S. stocks. We're owning some exchange-traded funds, mostly core positions, meaning your major indices, etc. The leading indices are still the NASDAQ and the Russell 2000, small-cap stocks. But at the same time, it's very important to watch this, because if the dollar is bottoming in here, which it looks like it would be in this bottoming process, and it starts to reverse up, we're going to see most of your stocks, certainly your commodities, go down in value. The other thing that we're watching is the bond bubble. Over the last 2 years, interest rates have been extremely low, if not the lowest on record. And if, with the printing of money and the buying of bonds on the short end that the Fed is doing, if the bond vigilantes come out and say, they force Ben Bernanke's hand by buying or bonds or actually selling bonds and forcing interest rates up on the long end. If China says we're not going to buy any more bonds on the long end, basically 10, 20, 30-year bonds, then we're going to start to see interest rates rise. It's going to have an adverse effect on Ben Bernanke's policy here. And one of the things that we would look for would be shorting bonds. There are some exchange-traded funds. Again, we're not doing that now, but we're looking at that in the near term. But we're kind of watching and waiting. We're seasonally in the best time of the year. It's the end of November. Generally, they call it the January effect. December, January are very, very good times for the stock market historically. The period of November through and the end of April, if you take that 6-month period of time and compare it through the May through end of October period of time, there's been studies that show the last 100 years that most of your return has come in the November through April period of time. So we're seasonally in the right time of the year. We're also entering the 3rd year of the presidential cycle. No matter who's been in power, Republican, Democrat, whether there's been recessions or wars, generally that's the best year for the stock market. So there's a lot of things in the stock market's favor, but the market does not have a watch, does not have a calendar, and we don't know exactly what's going to happen. That just means, probabilities are 60, 65% of the time it does better in those period of times. That means 30, 40% of the time it does worse in those periods of time. So, you can't just say, well, the calendar says, so we're going to just let it go. But things are changing. Corporate earnings were pretty good. But we're done with the easy comparisons. GDP, pretty good, showing slow growth. Unemployment still horrible. Housing still horrible. And that's been the big drag. Housing got us into this. Until we can solve the housing problem, I think that this is going to just prolong. But do we bounce along the bottom, or do we have another leg down? That remains to be seen. We're half optimistic, half not. We're playing with tight stops, and we're ready to rotate, and we're watching the dollar. Everything's inverse the U.S. dollar. Dollar goes up, watch out. If the dollar continues to go down, then everything stocks and everything else will do fairly well. Keep signing up for my newsletter. If you haven't done so already, it's right above my head over here. It's free. We just need your email address. If you want a free, no obligation portfolio review, call my office toll free, 800-449-9501. Toll free, 800-449-9501. Free, no obligation, second opinion. Calls free, reviews free. Use my 2 decades of experience to evaluate your portfolio and tell you how to protect yourself. Again, if you're catching this somewhere else, go to our website, www.yourmoneytalks.com, and sign up for a free newsletter. Have a great week.